Welcome to Adventures in Infinite Banking, Episode 1. A 28-year-old male, substandard rating. Now, this is the first in a series of true experiences that will demonstrate the usefulness and really the magnificence of the infinite banking tax-free cash growth warehouse finance strategy. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy. And I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. If you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. Now, if you're brand new to the subject of infinite banking, you may be wondering, what do you mean substandard rating? And what does that have to do with infinite banking? The answer is infinite banking relies on the rules governing the cash value of whole life insurance and the tax laws that protect and elevate it as a source of funding. So to practice infinite banking in the tax-free cash growth warehouse finance strategy, you need to own a whole life insurance policy. You can find the complete explanation of infinite banking in other videos right here on this channel. Now, here's the thing. Most folks don't know a whole lot about life insurance. And as a result, many think they would not be approved for a life insurance policy, or that if they have medical conditions, it would make the policy too expensive to be useful for infinite banking. While that may be the case, it's far more likely that they would be approved and the strategy will be very beneficial and helpful. So here I will present a true experience where it may seem the conditions are stacked against the client. A standard rating is given to those with no medical conditions that would contribute to an increased risk of early death. And that includes use of tobacco. There are better than standard ratings, such as preferred and ultra preferred, that are given to those who are in excellent health and so have a lower risk of early death. And then there are those who are given substandard ratings due to health conditions, and tobacco use is also a known deterrent to good health. Substandard ratings are assigned as table ratings and are designated by either numbers or letters. In this case, we'll be using the example of a 28-year-old male who smokes cigarettes and vapes and has a medical condition that, while controlled by medications, has earned him a table D rating, which is 4 steps below standard. This young man has a full-time job and makes a decent living. He aspires to start a business with designs that he makes for clothing and has manufactured on demand and then drop shipped from his manufacturing vendor. This is an actual case, but to protect the identity, his identity will give him the generic name of John Doe. Okay, so John's income is about $4,400 a month, and his expenses run him about $26 a month, leaving him about $1,800 a month of discretionary income. Now, John wants to build a business, and that requires marketing, which includes samples of his products and advertising. So he wants to be able to direct as much of his discretionary funds as he needs to his business. That is where infinite banking comes in. The questions at this juncture are, what will the whole life policy cost him? And how fast and how much usable cash value will it generate for him, especially with his table D rating? So let's take a look at that. Well, now you can see here that this is a $300,000 policy that actually starts with a $326,820 benefit. And that's because we've designed this policy to include paid up additions. And you'll notice that the first year, the premium includes $3,000 of paid up additions. After year one, the premium for this policy is just $506 per month, or a little over $6,000 per year. This is the annual premium amount right here. So, and notice how much cash value it has the very first year. Look at this, almost $5,500, which is 60% of the total premium paid the first year. $95% of the cash value is available to leverage with policy loans right from the get-go. That is not the case with standard life insurance design. These designs that we create for infinite banking are specifically for generating the most cash value as quickly as possible so that it can be used with the infinite banking tax-free cash growth warehouse finance strategy. Notice that by the fifth year here, well, the premium paid is still $6,029 for the year. The amount going into the cash value is $4,670, or now 77% of the total premium paid. And by the 11th year, the premium is still just $6,029, but the cash value grows by $6,165. That's over 100% of the money being paid in that year, and it just keeps growing faster and faster as time goes on. And that is unaffected by the amount or frequency of policy loans. You see here in year 15, now he's getting 118% of what he's paying in premium added to his cash value. And in year 20, he's getting 147% of what he's paying in premium added to his cash value. That's because the cash value continues to earn dividend interest even while it's being leveraged for policy loans. And I want to emphasize that with this particular company, the simple interest charged for the policy loans is less than the compounding dividend interest being paid by the company to the cash value. So that means basically free policy loans all the time, regardless of how long you take to repay the loans. And because by the 11th year in this example, the cash value grows by more than the premium paid, from that point on, the life insurance is basically free. And this is with a policy at a table D rating. Yes, the table rating does impact the benefit values in a negative way, a little bit, but still, the value and benefit this asset produces for the client is incomparable to any other cash asset. Let's take a quick look at what those benefits are. First, the cash value that is growing in the policy is growing with the highest compounding dividend interest of any cash value instrument, higher than high yield savings accounts, higher than top tier CDs, higher than bonds, and without the risk. At the time of this video, the dividend interest rate is 6.1% annual compounding interest. This cash value of the policy is fully protected against any attachment. It cannot be garnished or levied to settle debts or claims, even in bankruptcy or lawsuits. The cash value may be used by the policy owner as collateral for policy loans without stopping it from earning the high compounding interest. And those policy loans do not have a repayment requirement, so like banks do. So the owner can take as much time as needed to repay the policy loans or between payments on the loans with no penalties. And as with any loans, policy loans do not trigger a taxable event. In fact, the growth of the cash value from the dividend interest is not even reportable to the IRS for tax purposes. And in John's case, in our example, any interest he pays on his policy loans, even though he's earning more in dividend interest than he's paying in loan interest on the money, when he uses his policy loans to finance things for his business, that loan interest becomes a tax deduction. Let's take a look at how that plays out, shall we? Look here, in year one, John pays into his policy about $9,000. Immediately, he has about $5,000 in his tax-free cash growth warehouse, and he takes a loan of $4,000. With that loan, he purchases a new computer, hires a graphic artist to create a catchy logo, hires a webmaster to create a website and obtain a domain name and hosting, and he pays for a supply of his products to sell to local outlets. He doesn't make payments on the loan for a full year. So he gets charged 5.25% simple interest for the loan on the anniversary of the loan. That's $211.20. The same money in his policy cash value gets paid $332.94, even though he hasn't leveraged for the policy loan. Now, the $332 gain is tax-free, and he gets to deduct the $211 interest on the loan from his income tax. So he's made $544 by virtue of the dividend interest he earned and the tax deduction for the loan interest. But that's not all, because the costs he incurred for his business that he paid for with the policy loan, the graphic artist, the webmaster, the computer, the web hosting and domain, are all deductible as costs of doing business. So basically, he made all the money back in the way of tax deductions, plus the deduction for the loan interest and the gains from the dividend interest his money earned for him while he spent it to build his business. Altogether, in this example, John not only earns high compounding tax-free interest, but because he used the policy loan for business expenses, he gained valuable assets for his business, which continue to benefit him and his business, but he gets to deduct the cost of those expenses. The end result is, in this example, John has invested $9,000 in a $300,000 insurance policy and gained over $9,000 in cash value plus tax deductions plus $4,000 of assets for his business. Wow. Sounds like to me that John has about doubled his money in 1 year while launching his business and gaining a $300,000 asset, which is the life insurance policy. And all that while having a table D rating for insurance. Yeah. A score of 100 on the Rotten Tomatoes, 2 thumbs up, or whatever. This has been Adventures in Infinite Banking. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, the link to the application is also below. We're here to help. We look forward to helping you. Aloha and mahalo for watching.